Hello everybody, my name is Stephen James. I'm the Managing Director of ISS Corporate, and it's a great pleasure to be back here in Taipei and invited to speak with you all. From my first visit to Taiwan in 2008, 16 years ago, sometimes I shudder at how old I have become. I've always been made to feel very welcome here, and I thank you all for your hospitality. Today, I will cover a range of ideas and insights that can be understood in general as relating to how corporates can better manage their disclosure to meet the evolving needs of your minority investors, but in the context of their need to solve for longer-term ESG risk, which echoes much of what we've just heard from Belinda. Let me first begin by providing important clarification as it relates to the nature of ISS as an organization. I suspect that most all of you know something about ISS and have some level of personal experience of interacting with ISS, probably linked to the receiving and reading of the ISS proxy research reports on your own company. Let me provide some further insight as to the nature of how we are structured, that it will be helpful to understand as we go through the slides today. ISS is the world's largest proxy advisor. And what this means is that more investors all around the world rely on ISS research and the ISS vote recommendations more than any other resource to help them vote their shares from a position of knowledge. It follows, therefore, that ISS policy is material to you as an issuer for the simple reason that the ISS policy is material to the behavior of your investors. The best way to understand the ISS business is by reference to our internal wall, which separates the business on the right of this slide, which supports asset managers and asset owners, that's ISS stocks, and the business on the left side of this slide that supports you, the corporate issuer, ISS Corporate. ISS Corporate, who I speak on behalf of today, is very much separated from and acts independently of ISS. We're an issuer service provider, and we provide services that assist our clients to target closer alignment with the preferences of your minority investors and ultimately better capital market outcomes. We're bound to observe strict protocols of separation from ISS research, and that ensures the protection of any conflicts of interest and means the integrity of the research process is assured. So, today, I will speak with you about environmental and social activism, or should we call that active ownership? We will explore this further. We'll also talk about the establishment of consensus in terms of sustainability standards and what that means for Taiwanese issuers. And we'll finish with some data to consolidate our conclusions in respect of the Taiwanese market. I should start by saying that having followed the previous presentation, which provided an interesting view of how a particular investment house is using sustainability data to inform their decisions and the individual approach that they are taking to effective stewardship, my content instead will be drawn from a broader experience of how our advisors support multiple individual issuers with their engagement strategies. We can agree that engagement is one side of a coin, the other side of which is stewardship. The content I will cover will draw on ISS policy review considerations and our experience of effective corporate engagement strategies. My intention today is to emphasize the reality of what I will refer to as a new investor paradigm and encourage behaviors that issuers and the management of these issuers can do to optimize their navigation of this new paradigm. Let me start by jumping to the end, and then I'll go back to the start and we'll make our way to the conclusion. In this way, the key concept that we are promoting cannot be overlooked or misunderstood. Our story seeks to encourage corporate issuers to reappraise their mindset and attitude to investor engagement with a renewed understanding of the motivations, possible actions, and ultimate ambitions of their investors. I will attempt to encourage that we foster a new approach to understanding activism, or differentiating between active ownership and activism. Through this understanding, companies can better plan their disclosure and framework alignment with the incentives better understood. Now, while every company in this room and in the world has a unique capital structure, what we can say without doubt is that all of us now see an unmistakable trend of index investors taking up an ever larger proportion of your overall share register. Now, what's important to consider here for a moment is the almost counterintuitive implication of this fact. Your presence, your simple presence in key stock indices ensures that you will now enjoy these index investors in your register. It is possible, therefore, to reflect that such dynamics reduces possible anxiety or reduces the need to be sensitive to these investors and their preferences, based on a sense that they will not divest. But in fact, quite obviously, this is not a helpful approach to thinking about your investor relations program. The challenge today for the management teams of issuers with major index investors is to understand the motivations and requirements of these index investors and incorporate those needs into the decision-making that guide the evolution of your sustainability programs. We can think of index investors now not as passive investors, but as investors with active owner mindsets. These global investors broadly hold various asset classes across the global economy, and so they see environmental issues wherever in the world they are as disruptive to their effective profitability. This informs their approach to engaging and seeking to guide or control the direction of decision-making of their investee companies. The absence of divestment as a strategy does not equate to an easier ride for issuers. In fact, it translates to a more demanding set of expectations, with demands for greater transparency, alignment with global frameworks, and minimum standards when it comes to the governance of risk management. So how do companies best approach this? Well, we won't dwell on this slide too long, but to illustrate a point, the detail of this slide is it tells a simple story, a story of increased numbers of signatories of the PRI, Principles for Responsible Investment. And in the most basic way, this reminds us in concrete terms that PRI signatories are growing and that we can be reminded that all signatories are committed to active ownership. So let's expand on that. So to develop this point from the prior slide, which we have just confirmed describes a commitment to active ownership for all signatories, all we're doing here is unpacking in part what that means in practical terms. Being an active owner means voting shares, active engagement, sometimes filing shareholder resolutions. It also means, if we think about Principle 3, pressing investee companies to target standardized reporting, transparency, and specifically seeking ESG risks to be reported in a formal way in line with global guidelines. It being important to understand that this is an ongoing commitment, that the signatories themselves are required to report on their fulfillment of these ambitions each year. For companies, understanding the commonalities consistent with PRI signatories creates a potential roadmap as it relates to ESG risk mitigation. And it also predicts reliably areas that these investors will want to have satisfaction on, which in turn allows you to better prepare for investor engagement meetings. Now, until now, I've been telling a story of index investors with active owner mindsets. Let's just explore this a little further. Where does active ownership stop and activism, in the meaning of our traditional definitions, start? Let's take a step back and think for a moment about what we all imagine when we use the term activist. Historically, an activist has been characterized in terms of a hostile, conflict-oriented, scenario focused on a definitive short-term goal, often associated with targeting board seats or new approaches to capital allocations or alternative views on business unit strategies. Active ownership, by comparison, as we've been signaling until now in this presentation, is characterized instead by longer-term goals that do not need to run counter to the interests of your current management teams. We might think of index investor activism to be focused on the targeting of longer-term ESG risk mitigation, with such actions as climate risk disclosure, alignment with global guidelines, and greenhouse gas emission targets being set. And this slide demonstrates this visually with what we might consider now an anachronistic view of activism on the left side and a more contemporary view on the right. Now, there's a lot of information on this slide. I don't encourage you to try to read it all. But what we have here is a visualization of the devices that investors with an active management mindset are already using to exert their will on their investee companies. Now, on the one hand, these devices are understood by all of us here in this room today, and they range from the left with voting their shares, all the way to the right with litigation as a path of last resort. And you can see the escalatory options from engagement to shareholder proposals and proxy contests as we move to the right. What I want to draw your attention to here is less about the fact that these devices are known to already take part in the way that investors interact with their investee companies. What's more important for us to think about is the possibility that these devices are now implemented by index investors and not the preserve of specialist funds. Even if we have only just last month seen the start of shareholder resolutions in Taiwan, we can predict it will not be long until we see this here as frequently as we've already seen it in Korea, China, Japan, and elsewhere in Asia. Now, what we have here is a visualization of the growth of shareholder resolutions and the associated level of support from ISS. The purple line that runs across the bar charts is the level of support that these shareholder resolutions have received at the various meetings that they've been brought forward. And it shows well-established content areas leading the charge. We see climate change, greenhouse gas emission target setting, and board diversity as the issues that are brought forward the most. And of course, I again draw your attention to the level of support that these resolutions are receiving from proxy advisors, with 36, 33, and 30% support from ISS. Now, moving away from the subject of shareholder resolutions, I want to take a moment to share some perspective on how ISS has been reflecting on climate risk through the lens of their annual policy review process. A brief reminder, ISS annually engages with all market participants to review the evolution of ESG risk and how that risk should be crystallized into the following year's voting policy. It ensures that the voting policy used by ISS analysts continues to reflect the consensus view of risk from the point of view of the investors who use these recommendations. Now, going back to 2022, which informed last year's voting policy, I want to draw your attention here is that when asked whether the lack of climate change risk management disclosure should result in an against recommendation from ISS in respect of director election ballot items, 84% of investors thought that was a great idea. On the other hand, only 60% of issuers felt the same way. Now, that degree of divergence, 24%, if not bridged, can lead to dysfunction. Looking at the policy survey process for 2023, and that is informing voting policy this season, what can we see? Well, we can see pretty high support for TCFD-related questions from global investors. Investors expect to see disclosure on oversight of E&S risk at 95%. Investors wanting to see target setting, 88%. But again, it's interesting to see how, when it comes to materiality assessments, investors, 80% of them, consider this to be an important thing to do, whereas only 45% of issuers feel the same way. Again, it's interesting always to see where there can be a divergence between what investors want and what issuers want. Now, until now, this feedback has been woven into policy in a limited way, focused for now only on climate action 100 companies. But we shouldn't be surprised that with such consistent data from investors that we could imagine this being enshrined in the annual ISS policy update more broadly. What we are observing, in other words, is broad consensus on the materiality of TCFD, or TCFD alignment from investors, and an expectation that companies will demonstrate sensitivity to that. We will await with interest the next annual cycle. So now I want to change gears and focus our attention for a period on sustainability reporting regulations. Now, regulations as a subject, not super fun or interesting. They are, however, important. I will do my best to tell a simple story of where we have come from, where we are going, what others are doing, how that compares with Taiwan, and what Taiwanese issuers might think about that, and maybe most importantly, what Taiwanese issuers can expect in terms of increased investor demand. In English, we have a saying, don't shoot the messenger, so do please keep that in mind as we begin. Okay, so let's start by scanning out. We're going to take a global view. What are other countries focusing on when it comes to sustainability reporting? Now, there's a lot of information on this slide, and there is some degree of country specificity. But if we boil it down, we can see that there are two main games in town. CSRD, or the Corporate Sustainability Reporting Directive, which is dominating conversation and consideration in Europe, and IFRS 2, you will hear that quite a few times going forward, which is the guideline around which there is the greatest ex-EU global consensus. From an Asian point of view, and in particular from a Taiwanese point of view, it is all about IFRS S2. Well, nearly all. Based on some analysis that we've done, we understand there are 71 Taiwanese issuers who, as a consequence of European subsidiaries that they have, will be captured by CSRD. But these 71 Taiwanese companies, their subsidiary will be required to report in line with ESRS, which is the reporting standards derived from CSRD. This presents a choice. Will they, or you, if you're in the room, report in line with CSRD while the parent reports in line with IFRS S2? Or perhaps you'll consider a better option to report in line with ESRS for the whole group. In that way, you will have a single system to observe at group level. And ESRS compliance exceeds the requirements of IFRS S2. I apologize if your head swims with the acronyms. There's little we can do at this stage to avoid referring to them in any other way. Now, I want to drill down a little bit to the regional level. What do we see when we look around us here in the Asian market? While in mainland China and South Korea, we see general encouragement to report in line with TCFD principles, when we look to Japan, Hong Kong, Singapore, and of course here in Taiwan, we see a commitment to IFRS S2, albeit with different timelines. Now, the point I want to make here, and I think it's an important one, is that when we consider the date that you are set by each country for reporting in alignment with IFRS 2, I want to encourage you to think of this date not as a target, but as a last possible moment that you can be in alignment with this. As you consider the preferences of your minority global investors, it's important to reflect on how these guidelines derive in large part from their comments on the data they want to see to inform their portfolio allocation decisions. It follows, therefore, that the sooner you are reporting in alignment with IFRS S2, the sooner you are operating at parity with your global sector peers who may already be operating at that level of transparency. Mindful of how these global investors effectively own a stake in the world economy, their view of risk is closely bound to the requirements of these methodologies. As you accelerate your alignment, you optimize your capital market outcomes. Now, I hardly dare cover this slide in too much detail. Describing meaningfully the obligations of sustainability disclosure regulation is not interesting, and yet I cannot ignore this if the rest of my comments are to be understood. So allow me some license while I oversimplify the journey that we are all on, such that the remaining slides that I cover can have more meaning. Where were we? We were at IFRS S1, and this was in 2021, and it created the starting point for this formalized sustainability disclosure. Where did we go next? We went to TCFD, which raised the bar and created consensus for climate-related financial disclosure. Where are we now going? Well, as we've seen, and as almost all of you knew already, we are heading towards IFRS S2, which in simple terms requires much more sophisticated climate-related disclosure. So, let's take a moment to consider what is the state of play today for Taiwanese issuers when considering climate disclosure. Now, I should caveat this data by stating that the results that we're looking at on screen, and I draw your attention to the left side of the slide to give you Taiwan data, the right side of the slide to give you Asian data, ex-Taiwan. But these results are derived from the ISS quality score data points, and that currently covers only 101 Taiwanese issuers. So I would suggest that this is a significant number, but not clearly a comprehensive one. Nevertheless, credit where credit is due. Taiwanese companies are performing well, and you should be commended for that. As we look to the left side of this slide, we can see that 89% of these 101 Taiwanese companies are meeting the standards of TCFD alignment. If we compare that with the overall Asian performance, we can see that that number is only 58% of non-Taiwanese issuers meeting overall TCFD guidelines. We should, however, in the spirit of progress, consider, however, that there is 0% on the far left within Taiwan, 0% of companies in Taiwan who are exemplifying the standard of TCFD. And of course, that represents the next stage of progression for companies here. So with all of this good performance, what does it mean? Should we all get the cigars out and relax for the next few years? Or is there more work to do? Well, unfortunately, we must put the cigars away for now. I don't even know if people still smoke cigars, but it seemed like the right thing to say. What we are looking at here on this slide is a description of what the additional work between TCFD alignment and IFRS S2 alignment looks like. You'll see that the extra work is conceptualized in the same terms as TCFD in terms of the 4 pillars, so governance, strategy, risk management, and metrics and targets, but that it goes deeper. And we've highlighted in yellow key concepts to have in mind for each of the pillars. So in governance, there will be a need to see more detail on the extent to which executive compensation is tied to climate considerations. In strategy, we will need to see more information on your ability to decommission or upgrade or redeploy assets based on issues identified in scenario analysis. In risk management, we want to see more evidence that climate-related scenario analysis has informed the identification of your disclosed risks. And in metrics, we want to see more evidence on the percentage of your business vulnerable to climate-related risks. Now, this visualization provides a really good perspective, if perhaps a dispiriting one, on where a company that is well aligned with TCFD still falls short of what will be expected of IFRS S2. So you can see there's still much work to be done. To make sense of this slide, companies well aligned with TCFD today are represented in dark green. This describes how much more work is involved. You can see light green can be understood as an upgrade to your current disclosure, but the orange segments represents a completely whole new set of demands. I should also remind you that I do not have a view today on what the other 800 main market Taiwanese issuers look like in terms of TCFD alignment. If that remains an ambition of the future, then clearly IFRS S2 is yet still a more distant ambition. Okay, so let me conclude this presentation with a little bit more perspective on Taiwanese issuer ESG performance. Spoiler alert, you're all performing pretty well. Now, I'll be providing perspective on Taiwanese issuer performance through the lens of ISS ESG's rating methodologies. It's important to remember that despite all of the commentary I've made about global guidelines, and if we think about IFRS S2 and CSRD, and how they encourage materiality assessments, these are designed to provide a consistent but very company-specific view on sustainability risk. It remains the case, however, that investors continue to rely on the ESG ratings and ESG rating providers to deliver a consistent, in the UK we say apples to apples comparison, analysis of companies at scale. Proxy advisors and ESG rating providers exist to solve for this demand, and so issuers are well served keeping that in mind, developing a plan for optimizing your ESG ratings wherever possible. We will refer to ISS Quality Score, which is a relative decile indicator of risk, and the ISS ESG Corporate Rating, which is a granular qualitative analysis of ESG performance, taking account of all the available signals. We might think of this as the jewel in the crown of ISS ESG. Taiwan is in blue. The punchline here is that Taiwanese issuers, again the caveat being we're looking at 102 Taiwanese issuers, so significant but not comprehensive, perform very well. If you look at Taiwan in the blue, it outperforms Asia and the rest of the world from grades A- to C-. In other words, Taiwanese issuers are overrepresented in the high-performing alpha ratings and underrepresented in the lower alpha ratings towards the right side of this chart. What we see here in this visualization is Taiwanese issuers scoring in environmental and social quality score deciles, and again, Taiwan is in blue. We see the same story. Overrepresentation on the left side, which is numbers 1 to 5. This is low risk. Underrepresentation on the right side, numbers 6 to 10. This is high risk. Again, 101 of the larger companies, but still worth commenting on and celebrating. Do you want to know how ISS clients are using ISS data? Well, I think Belinda knows rather more than I do, but what we managed to get from our colleagues before I came over on the plane yesterday is new data, which I'm happy to share with you today. I don't have time to go into this in detail, but let me explain what we're looking at. These data points are the 10 most heavily selected data points that are being included in customized data feeds of ISS investor clients. Now, this data is being aggregated and anonymized, but what we see here are the data points requested the most, and therefore, inevitably, it must be of interest for us. And what's important to consider here apart from the actual data being requested, is the fact that all of these data points derive from the ENS quality score rating. Companies that actively manage their ESQS rating are optimizing their capital market outcomes. And to quickly make a point in relation to the last slide, we saw the number one data point being gender pay gap. What we see here on the right side is the percentage of Asia-Pacific issuers disclosing gender pay gap information by sector. The highest performing sector being real estate, but still only just over 20% of issuers meeting that demand, with energy performing most poorly with no evidence of such disclosure. So there is work yet to do, even here in Taiwan, when considering gender pay gap disclosure. Now, at ISS Corporate, we see corporate sustainability performance in terms of an annual cycle, characterized by continuous reappraisal of materiality, which informs the scope and scale of target setting and reporting, and guides you as you consider your capital market engagement strategies. I hope you found this interesting, and a special prize goes to the person who comes and finds me later and correctly tells me how many times I use the term IFRS S2. And I'm grateful for your attention.